All right, for this week's Monday rate update, I am not coming to you from Oahu. No, I am coming to you from Valtellina in Italy. And actually, I'm at my castle. This is the castle I'm staying at. You see at the top of the castle, it's pretty cool, looking up and down. This is the largest east to west valley in all of Italy, known for its grapes, wines, apples, great farm, huge amounts of farmland here. And this is where I'm going to be this is my home for the next week. So I'm super excited to bring you the Monday rate update. And there are three things that are really going to kind of carry the storyline this week. First is the Treasury and the Treasury's intervention into the bond market. We'll get into that. We also have the Fed. The Fed is meeting this week at Jackson Hole, Wyoming, and that is going to have some impact. And then, of course, we have the Middle East and what's going on in Iran and the Strait of Hormuz. So we're going to break all three of those things down, kind of go over what's going on within the markets during the week, because there's a couple really big reports coming out, and then we'll kind of see where we're at rate-wise as we start the week. So let's get going with today's Monday rate update from Valtellina, Italy. Look at that beautiful, beautiful view. Oh, majestic. We're right up here north of Milan in the Italian Alps. This is actually right near where the Winter Olympics were held in February, just up the road in Bormio, and just something beautiful out here. So let's get going. Actually, I don't even want to do this right now, but I'm going to do it because I do it every week. And just because I'm in Italy doesn't mean I'm going to stop. I'm just going to have some wine as soon as we're done. So let's get into it right now. All right, so as we start the week, interest rates on Friday, they went up. We start the week 6.77 is the average across the nation, 30-year fixed rate conventional mortgage. VA is a little lower, 6.35, so almost 40 basis points, actually over 40 basis points lower for your VA rates versus conventional. And man, look at that 10-year Treasury. We were under 4.7 for most of the week. By the end of the week, though, at 4.73%. So that's definitely not moving in the right direction. We thought maybe with the Treasury taking action, at least stating that they were going to double their Treasury buying back from $2 to $4 billion, that would help. It helped for a day, but really, it's not solving the problem. It's a Band-Aid on an open chest hemorrhage. Really not where we need to be. You can see rates going up. And so really, basically the hook for the week is, hey, the Treasury is trying to step in because they know what the Fed is doing right now isn't going to lower mortgage rates and long-term rates. And that, my friends, is a big deal as we get into the midterm elections that come up in November, and affordability is on the tip of everybody's tongue, not just the politicians, but the people who are voting for them.
Okay, before we move on, I gotta say this. 91% of people watching this video now aren't subscribed to the channel. And look, if you're a Hawaii buyer, a veteran using your VA loan, or you're just trying to time the market right, this is exactly the kind of update you don't want to miss. So hit subscribe now, turn on notifications if you can, and let's get to the next report.
And as I said before, there's a lot of different news coming out this week. Monday's pretty light, but Secretary of Treasury Bessent is going to speak. He has a speaking engagement, and he'll be talking about the Treasury buyback and kind of giving what his impression of what that will do for long-term rates. Tuesday, we have a ADP weekly employment report. Wednesday is a big one, or a big day this week. We have PCE, which is personal consumption expenditure report for the month of July. Expectation, last month we were at 3.3% on the core. Expectations will be at 3.3% as we get this report. We have durable goods, and then we have the second estimate on second quarter GDP, gross domestic product. It came in at a paltry 1.5%. Expectation is that it'll stay there. If it comes in higher, that will be actually good, for the economy. If it comes in lower, that actually might help interest rates go down a little bit. Thursday, we have the typical initial and continuing jobless claims. We really haven't seen an uptick in either of those. Nothing measurable or nothing that's going to move the market. And then the Jackson Hole Symposium begins. Friday, there's a couple really big pieces of news coming out. First is the payroll benchmark revision. In the past, we've seen huge drops in the number of jobs that are reported in the BLS jobs report, basically negative revisions. Expectation, again, is that we'll have negative revisions. And if it's a big one, well, that could really put a dampener and maybe cause the Fed, certainly cause the Fed not to raise the Fed funds rate, not likely going to cause them to lower it unless we see inflation start going down. But the unemployment rate went down to 4.1% last month, and it's a different survey. That's the household survey versus the business survey. But, that may show that, that low unemployment isn't really that low. And then Fed Chair Warsh will speak on Friday. He's not going to have this information necessarily to talk, but he's going to talk about basically what their plan is for the Fed coming out of this symposium, really for the next year. That's a big day, Friday. So Wednesday and Friday this week. So again, not a lot of housing news specific, but a lot of news that's going to move the market. So again, let's get into what the three storylines are driving this week. All right, the big thing, one of the big storylines this week, again, is going to be the Treasury and its intervention into the bond market. The Fed has not lowered the Fed funds rate, which is a short-term rate, but they haven't done anything that would lower long-term rates to include mortgage rates. The Treasury actually doubling their bond buyback is basically the Treasury saying, you know what, we're going to act in lieu of the Fed not taking action because we want long-term yields, i.e. mortgage rates, to come down. They're going to be buying, going from $2 to $4 billion, buying from basically the beginning of September through the election to help bring down those long-term rates. Again, we're at 4.73 on the 10-year Treasury. We're well over 5% on the 30-year Treasury, which again is not mortgage rates. But if the 10-year Treasury starts to go down, are they acting independent of each other, the Fed and the Treasury? Yes, they are. The Treasury basically is stepping in and saying, hey, we're going to take action because we need rates to come down. So remains to be seen, again, what the long-term impact is going to be. But, again, not sitting back. Inaction is action by virtue of not doing anything. The Treasury is definitely taking action. The Fed has been talking about a very strong labor market, but when you look at the July payrolls, all right, the expectation was there would be 85,000 new jobs in July, and actually it was a negative 23,000, so almost 100,000 person delta in new jobs. All right, that report in and of itself, followed by a lower CPI report, brought the odds of a Fed hike down from almost 80%, actually 60% down now to 33% chance that they will raise the Fed funds rate. We'll see what the inflation report looks like, and certainly the revision on Friday, but the expectation really is the Fed's not going to do anything at their September meeting. And again, the Fed is talking on Friday. We got that revision coming out on Friday. Friday could be a very big market moving day for mortgage rates. Depending on the tone of Fed Chair Warsh, if he says, "Hey, a hike is not on the table, it's not going to happen in September," that will be very good for mortgage rates. Again, not likely that they're going to cut the Fed funds rate though. But it'll be interesting to see what their tone is coming out, or Fed Chair Warsh's tone is coming out of that report. It will impact mortgage rates for sure. And then the third item that's really going to move the market this week is the status in Iran and the Strait of Hormuz. The U.S. is saying, hey, we have full flow of traffic going in and out of the Strait. Iran is saying the Strait is closed. Iran is saying they have won. But the Iranian president is saying, hey, we need to stop this war now because our economy is in shambles. Their inflation is 2,000% or some ungodly number. The proof is in the price of fuel or the price of oil. All right, we were in the 80s last week. As we start the week, we're at $93 a barrel, almost $94 a barrel. West Texas Intermediate crude is up to 86. Again, we need to see oil prices come down. The difference between this year and last year this time, gas prices in the U.S. are actually $1 higher. Again, as we go into the midterm elections, President does not want to see high gas prices. He wants to see affordability not be on the front of everybody's mind when they go to vote. And right now, with affordability being an issue, inflation being higher, unemployment, who knows where unemployment is really. We can't really trust those numbers. But what's going on in Iran and the Strait of Hormuz, not a lot of action, not a lot of kinetic military action, but how much oil is really going through the strait and through the pipelines from Saudi Arabia to the Red Sea. A lot going on, those three things. And all three of those things will impact mortgage rates this week. All right, so what does this all mean for buyers? Well, Washington acknowledges, Washington being the president and the Treasury, they acknowledge that they need to bring rates down. They've taken action, started taking action last week. They will take action through the rest of the rest of the year up until the November elections. This is a good opportunity now. Rates may come, if rates do come down, it is a good opportunity to strike while many people are sitting on the sideline, and you can still get some great credits to cover your closing costs and to buy down your rates. Again, Friday, big day. Friday, 2 headlines: revisions, Fed Chair Warsh speaking, and then hike to cracking in 2 weeks. All right, again, we had low unemployment, we had high inflation. That was a good reason to raise the Fed funds rate. Well, now, 2 weeks later, definitely not likely that we're going to raise the Fed funds rate at the September meeting. Not likely we're going to drop it either, but definitely will be a lot more dovish, I expect, coming out of Jackson Hole on Friday. And really, my closing thoughts are, we've seen this with so many things that this administration has done. They're not waiting for somebody else to take action. They are taking action. Putting basically action behind the words. Affordability is a big deal. Well, buying Treasury bonds, that could in the long term hurt, but in the short term, it could bring mortgage rates down, bring long-term Treasury 10 to 30-year Treasury bond yields down, which would be good for the economy. So we'll see a lot going on this week. Definitely, if you have not subscribed to my page, please do so, because I'm sure on this Thursday, we'll be talking a little more. We'll have a little more fidelity on what's happened this week with some of the reports and what's going on in the Middle East. There'll be some changes for sure as we head into Friday and another week. Actually, the last week in August already. We're almost done with the third quarter. We got 1 month left in the third quarter. And man, I tell you what, it's a lot going on. There's never a lack of news going on, certainly in our country, especially as we head up into elections. And I try not to I'm not getting political on this. Everything happens for a reason. We'll see how this goes, but not a gambler. I'm a firm believer that if you can lock in a rate, you lock it in, because while I do think there's a good chance rates go down this week, there's also a really good chance they go up. So not much help to you there. That's why I don't gamble. That's why I lock it. All right, have a great week.